Today, we are going to talk about financial freedom blueprint, how you in your 20s to 40s can invest in your financial capital to leverage compounding and avoid midlife wealth traps. This is a blueprint which any one of us can use and can take the maximum advantage. Now, let us first talk about human capital versus financial capital, how both of them resonate with each other if you want to make wealth in long term. Now, human capital is the ability to learn new skills, gain knowledge, be good with health, gain good experience, and be more productive. Normally, you get the maximum of your human capital in your 20s to 40s. Financial capital is the asset that earns passively. It could be your equities, mutual funds, gold, real estate, fixed income businesses. Now, the strategy is to invest aggressively in financial capital while your human capital is strong. That is, once you are in your 20s and 40s. This will help you to gain advantage with the help of law of compounding, because it is this law which is going to multiply your income and make you a wealthy person. Normally, people make mistake. They increase their spending, they increase their expenses as soon as their salary increases. That is the lifestyle inflation. With the increase in salary, they increase their lifestyle. And that is why they are never able to make or sustain a healthy growth in their corpus. So let us understand some of the middle class money traps. Why people normally fail in the middle class. One of the major reasons is early on in their careers, they get into EMI trap. They have so much loan, so many loans on their name that every month more than 30 to 40% is just paid off in form of EMIs. Most of the youngsters were not aware financially. Take home loans early to create long-term lock-in and reduce the possibility of creating a corpus over the long term. Car loan EMIs increase the fixed monthly burden. Most of them have credit cards, which also get converted to EMIs that erode saving discipline with high interest. So the recommendation is, if you don't want to get into the middle class trap, is not to get into heavy debt. You need to prioritize. You need to understand the early you start and the more time you give for your money to grow, the law of compounding will start to wonders. Once you understand this, you are never going to be in the middle class trap. Let us also understand what are the emergency financial essentials. Now, we are living in a decade wherein everything is so uncertain. In the age of artificial intelligence and machine learning, you might lose your job the next day. That's something which is quite evident with thousands of layoffs being happening every week. You, as an individual, as an employee, need to create an emergency fund on priority, which could be anywhere between 3 to 6 months of your expenses. Put this amount in a liquid account wherein you can withdraw it as per the requirement. Also, you need to have health insurance in case anything goes wrong with your health. All the accumulated wealth will go in making you fit. So it's better to take an insurance so that your capital is secured. Term insurance. Let's imagine if you have a family, you have dependents, you have kids, and something happens to you unfortunately and you are no more. Who will take care of your children? Now, that is the term insurance is going to take care of them. So you need to have the order of priority before investing. First, build an emergency fund, secure your health insurance, buy term insurance, and then start your journey of investment. Now, for any person who is on a regular monthly income in form of salary, the SIP, that is systematic investment plan, is the best channel through which you can start your journey of investment. Once you do SIP over a period of time, there is a concept called average cost buying. That is, you will buy more units when the market dips. And over a period of time, it will lower and make more units for you, especially during market downturn. Also, law of compounding works wonders with your reinvested gains and grow exponentially over a period of time. You need to have a disciplined and automated system which reduces market timing risk by smooth purchases. Ensure that you are investing at least 5 to 10,000 of rupees each month through SIPs, because this is the most fundamental aspect of making wealth for salaried individuals, steady income over a long period of time. Normally what happens when the market crashes, people panic. They take out money, whatever is left in their account. But that's the worst thing to do and should not be promoted as well. Always during the downturns, keep doing your SIPs. The crashes are for you as an opportunity. Buy more good quality stocks and mutual funds at a low discount. Your focus should be long term, 10 to 20 years down the line, how much money you're going to make. Don't stop SIP or redeem it when the market crashes, because you're not averaging the cost of the investment. Never let your emotions drive decision. Your discipline and perseverance is going to make you a great investor. This is how you're going to change the definition of being an investor and getting out of the middle class trap. Now, there is another concept called goal-based investing. It's a foundation to avoid costly mistakes. You always have certain goals at fixed period of time. For example, 10 years down the line, I would want to get married. 5 years down the line, I would want to have children. My children will start going to school. After 20 years, they will graduate, or they might want to extend and go for higher education. Then my children will get married. Now, these are life goals. And at every life goal, you need certain amount of money. And to have money at that point of time, you need to plan yourself. That is, you need to plan your goals. So first, find out the reason why money is required. Set priorities and constraints in order to make sure that you are saving that much amount of money. Determine how much time you would want and what amount would you require at that period of time. Choose a product for investment, a mutual fund, stock, ETF, gold, real estate. Whatever suits you best for the time horizon, choose a good investment product. Calculate the corpus required for you in order to achieve the goal you have planned. Allocate assets and define your risk tolerance. Whether you take more risk, be conservative, or do not want to take risk at all. So these are some of the important lessons which I'm sure you would have learned in this video. And at the end of the day, you are going to help yourself become a wealthy person.